Milwaukee. We have these hangouts about once a week on the average with people who are players in the greater Milwaukee entrepreneurship ecosystem. And we have with us today, and I hope that I don't get the names wrong, it's Paul Sweeney, is that correct?
That is correct.
Well, that's one of the easiest names in Milwaukee that I've been able to pronounce.
Well, I don't have a Polish background.
I'll just say that the project called Scale Up Milwaukee has completed the phase 1 proof of concept. The phase 2 scaling up Scale Up Milwaukee early in 2014. And so these hangouts we're having are partly a way of also providing some continuity. Our partners and supporters, we have to always thank them because we really owe a lot to the supporters, and they include, in no particular order, the University of Wisconsin at Milwaukee, the GMC Greater Milwaukee Committee, American Express Open, WIDA, the Mayor's Office, Wisconsin Economic Development Corporation, and I really hope I haven't forgotten anybody. If I have, Maggie will let me know. So, Paul, we talk about growth. We talk about scaling up of companies. We talk about the factors in the Milwaukee region which enable, foster, and also which inhibit or potentially inhibit that growth. So you have a very interesting background. Now you're, I would say, calling a private equity firm. Is that an accurate description? And if it isn't, give us a couple sentences on what you do.
Yeah, no, we're a private equity investment group. We're a little bit unique in that, like most traditional equity groups, they have a fund, right, of committed capital from institutional investors for the most part, and generally of a pretty large size. We are what I would call more of a pledge fund, or we do transactions on a deal-by-deal basis, meaning we don't have committed capital, but we've got a network of roughly 90 individual investors, many of them who I would consider entrepreneurs, but also just wealthy individuals who have an interest in diversifying their investment portfolio, outside of traditional public equities and real estate and such, and so they use us as an avenue to take an ownership stake in privately held companies. So
you say on a case-by-case basis, they basically syndicate the investment.
Correct, and they're generally we're for the most part we're doing what I would call management buyout transactions, but we will do some, which I would say is more closely aligned with Scale Up Milwaukee. We will do more recapitalizations or growth financings where we're not necessarily taking a majority ownership, but we'll end up being a minority investor in, again, a more growth-oriented company where the capital that we're investing is not being used to buy out shareholders or provide liquidity to anyone, but basically to support the growth of the company, whether that be physical equipment, property, or working capital for receivables and inventory financing, things such as that.
Let me just read from the website, assuming it's reasonably up to date, some of the deals you've been in, because I have a question about that, just as a follow-up. You've done a buyout of subsidiary area of ovens and material processing, fit-ins for hospitals and others, package equipment, printing and equipment, stamping, provision of car floors, more package, stainless steel signage, and so on and so forth. So what's all this talk about information technology and life sciences? This is different, and yet I'm sure you're making money. Otherwise, you'd never be able to convince the investors to stay with, right?
Yeah, I mean, it's just probably what our comfort level is. The types of businesses, again, we're investing in, again, more manufacturing oriented. I think that's probably more of what there are around southeastern Wisconsin today, because generally we are not doing startups, and so they're a little bit more mature companies. But again, some of them are more growth oriented. But you just find much more of those manufacturing oriented companies that have sort of hit that $10 million mark in revenues, which is typically when we like to get involved. Not to say that we would not look at a more of a technology-oriented company. In fact, the one we're working on now is a software information technology company in the state here that's looking for some growth capital. So we will look at those. It's just what we find more day to day are the manufacturing-oriented businesses.
And these are businesses that somehow made it on their own to $10 million revenue. And as you say, whether it's motivation, whether it's situation in life, whether it's the market, or with capital, something got them stuck. What do companies that are, let's broaden the range a little bit, what do companies in the $3 to $10 million range of revenues, post-revenues, these are not startups, they may be 40 years old, they may be 10 years old, they may be 5 years old. What do they need in Southeast Wisconsin? That's sort of the footprint that Scale Up Milwaukee is focused on. What resources do they need to grow and to be really significant players in their particular markets so they can provide a return to the shareholders or whatever else they're looking for?
There's probably a variety of factors. I think most often it is access to capital and to people. In fact, we are not necessarily directly through PS Capital, but more individually. My partner and I are investors in a good example is a company called 7 Marine, which is it's a unique company in Germantown, Wisconsin. It's sort of beyond the startup mode. I don't know if they probably haven't reached even the $1 million mark in revenues yet, but they basically have come up with they've taken a car engine and a Cadillac car engine and converted it to a outdoor marine boat engine with the horsepower, which is probably 2 times the size of anything out there today. And they're getting all kinds of interest, and they've basically taken it from a startup to a production line up and running. But again, their biggest issue day to day is how to finance the growth, because as you know, whether having to finance the build up an inventory, having to finance receivables, because a lot of customers today are not paying in the traditional 30 days. It's more 60 days or even 90 days for some customers, and someone has to fund that growth. And a lot of times, companies in that smaller size range do not qualify for traditional bank financing. They just can't go out and get a line of credit like most $10 or $20 million companies can. And so, how they find the financing to support that growth, especially in this case, it's going to be somewhat dramatic growth, is the biggest issue. And then I think the other challenge that they have is getting the right people in place. Because again, even with all the capital in the world, if you don't have the right team, they're going from sort of startup to a full production line, and there's a lot of complexities that go along with that. And going out and finding the right team members to bring in that have the experience in doing so is not an easy thing to do. And so I think putting the right people around you, whether direct employees or putting together a board of advisors or a board of directors that can help you avoid some of the pitfalls that probably most companies go through, is critical for these companies to break through that $2 or $3 million mark and then slowly get to the $5 or $10 million mark.
I've been all over the world, and I do projects all over the world, or almost all over the world. And when you talk to companies that are post-revenue, almost always up their list is people of what they need to grow is people, but close behind is capital. Sometimes capital's first, growth capital. But is there anything unique about Milwaukee in this? And the need for growth capital, or to finance growth, and need for human capital to support growth?
I don't think there's anything unique to Milwaukee. I just don't think Milwaukee has as many sources of growth capital as possibly some of cities that we might consider competitors in our size range. There are relatively few established venture capital funds here that, again, that might invest in this type of level of growth stage. And although we have started to see an increase in the number of investment, what you want to call angel investor networks, whether it be the Marquette Golden Angels and there's several others, there's still relatively few. And again, they don't invest obviously in everything that comes their way. And so there's just not that many sources for companies that are in that. Again, they're beyond startup, right? They're proven, they've got revenues coming in, but they're just trying to get to that next level. There aren't a lot. You really can't go to your traditional senior lender for that type of thing. There's just not this culture of entrepreneurial investing, I think, in this city that there might be in others, and that's where I think there's a big opportunity for improvement.
So it's a big opportunity for improvement. So the natural people to improve it would be your competitors, so to speak, people who can potentially syndicate deals but are now based in close by, Chicago, let's say Madison, or someplace not too far, would come in and say, you know what, you're making money. There's an opportunity for me too. I'll come in and maybe we'll compete for deals. Maybe we'll join forces together for deals. But is the lack of that kind of growth capital, is that just because the market's functioning efficiently, or because it's not functioning efficiently?
I'm just not sure if these types of investments necessarily fit with more of the traditional investment groups. As I said, we generally have more of a $10 million threshold of revenues or when we want to start investing. The company I mentioned, the Seven Marine, that's again something that we're just doing individually. We're not doing it through PS Capital. And I think if you look at the other more traditional private equity investment groups that are doing probably, again, more later stage growth financing or buyouts or recapitalizations, and there's probably 6 or 7 in town. I'm not sure how many of them would really take a long look at a company doing $1 or $2 million in revenue today. It's partly it's just risk return, right? There's a lot of companies out there looking for capital. Some of them are going to be very successful, but a lot of them are not. And so I find it difficult to do those types of deals through PS Capital, only because of the risk return threshold. You need to take such a large ownership stake in that one company that's really successful, potentially to make up for the other ones that you passed on or you'd invested in that didn't end up turning out so well. It's almost like building a venture capital portfolio. You need to do a lot of deals, and hopefully the one that hits big and it makes up for all the other losers in the portfolio. So it's hard, again, for more traditional private equity firms to dabble in this space, because you either have to be in it or you're not. And I think, then you look at more of the venture capital side, which is more of a fit for, they tend to be focused more on the higher tech type businesses. And so I think there's this void left of maybe more traditional, unique manufacturing companies have come up with a patented product or something, again, that differentiates them, but they don't necessarily fall in the high-tech venture capital bucket, and they're also not large enough to get traditional private equity financing. And so where will they go to get that kind of capital? And to me, it's coming through more of an individual investor network that they need to go out really through their network, through their working with a law firm or whatever resource they can find to get put in touch with people that have an interest in investing in these things on a direct basis.
What I'm trying to understand is whether you think, Paul, that this market, this segment of the market, let's call it early stage growth capital, just for lack of a better word, is this private equity market in the southeast Wisconsin region, is it rational or is it irrational?
I think the private equity market is rational in terms of the types of deals that they're trying to do, but I don't think it fits necessarily very well with the types of businesses that you and I are talking about today.
Well, that means it's irrational, because if it doesn't fit, that means either the businesses should leave and go somewhere where there is that kind of capital, or there should be an influx of that kind of capital that can get good risk, can get return for the risk they take.
Well, no, I agree. No, I mean, I think there needs to be new investment capital that's particularly focused on that market niche, and I don't think as far as I know, I don't think that really exists today. I know the state has done some work to try to incentivize, whether it be individuals or firms, to try and invest in these types of companies, although it's a relatively nominal dollar amount in terms of how much they've allocated to it. So I think those types of programs can help attract more capital, but I think there's going to have to be substantially more of it if they're going to hope to see some success from it.
Keeping that layer of capital, private equity, what's keeping that out is lack of information about the opportunities, bad deals, bad deal structure, or just experience. which is lack of information.
I'm sorry, can you repeat that again? You broke up a little bit.
Okay, is that layer of capital staying out of the market because of lack of information? In which case, it's relatively easy to fix from an economic perspective, or is it staying out because of lack of examples, or it's staying out because those deals should actually move somewhere else, to go where the capital for that layer of capital already exists?
I think partly it's lack of identified sources. I think the money is there, right? There's a lot of wealth in this community, and I think generally people are reasonably open to hearing new ideas and new opportunities. But I think it's having a mechanism place where those individuals with those ideas and those business plans, again, it's more than just a plan, right? These are up and running businesses with generating revenues. It's how we put a system in place where we can match those opportunities up with the individuals in our community that have the financial wherewithal and interest in investing in those opportunities. And I don't think there's an efficient mechanism in place today to see that happen.
So the mechanism is a market mechanism. You're saying that the market's not functioning well. That's basically what you're saying in other terms.
Yes.
That's the mechanism. Let's go back, Paul. You're investing in companies that are, let's say $10 million in revenues. If you could give, and let's talk about the growth companies, not the ones you're bailing out, but the ones who are growing and you're providing growth capital for.
Right.
If you could get them 5 years earlier, just as an advisor, and you probably are in touch with someone that you hope will get to the $10 million age and can invest in, what advice would you give to the company just breaking 1 million on how to get to 10 million in that region, in some of those segments that you're involved in?
The one piece I see a lot is companies are, when they do get that initial influx of capital, whether it be from friends and family or their own personal life savings and such, they've got to recognize that it's going to take a longer period of time and be more challenging to raise that next increment of capital. And so they have to do everything they can to preserve the amount of capital that they do have. And so, and I don't have any magic answers for them, but what I probably often see is they run out of capital, right? They end up trying to do too many things at one time, or before maybe you can get to revenue positive and start actually getting some income come in the door, possibly defer any other types of expenses that you possibly can, just to give you a greater ability to run rate or run time before you have to raise that next tranche of capital. That's probably the biggest thing, and also stronger financial planning. I mean, to really put together a detailed, even if it's weekly or monthly or quarterly, of what your cash burn rate is, or how quickly you're going through that stockpile of capital, and anticipate. Because the other thing too is I see often is they finally get to the point, hey, we're running out of capital, but now they've only got a month or 2 months or 3 months left. This process of raising capital does not happen that quickly. It takes months, 6 months, maybe as long as even a year to go out and efficiently, most cost-effectively, raise capital to take you to that next level. It's not going to happen in a month. There's not that magic bullet out there, that magic investors that's going to come in, do 2 or 3 weeks of due diligence, and write you a check. I'm not saying it never happens that way, but most often it doesn't. And so it's being very thoughtful and again, very strong financial controls and projections to anticipate when that next time is going to come along that you need to be able to raise capital, and making sure you achieve certain milestones along that path, so when you go out to raise that next tranche of capital, you can raise it on the best possible terms, meaning the highest possible value for your business.
Now, I get the feeling that that's not the kind of advice that most startups get. I'm talking about startups now. People that are just starting their ventures, I don't think they get that advice. I think they're getting the advice that's more focused on how to develop their products, how to develop their markets, and less on financial planning.
I would think that's probably the case. Because that's quite frankly, the financial planning isn't the sexy part of it, right? It's extremely important because it's what pays the bills, but it's not, again, it's not how we're going to market this, how we're going to expand our customer base from this to this, and all the exciting things about growing the business, but it is, obviously, it's a very fundamental part.
Yeah, human resources is not very sexy either, but it know how to hire the right people. As
Right.
you say, the two bottlenecks are growth capital and growth human capital as well.
Yeah, even with the people part, you talk about, okay, you want to bring some people in, maybe you want to incentivize them with ownership or give them a piece of it, but even that becomes extremely complicated, and I've seen a lot of companies get into trouble where they bring too many people in or they give too much ownership away to the initial people, and so then when it comes down the road and they need to bring in that next tranche of management, they've already given away or not maybe given away, but sold at a relatively nominal price ownership to that first group, which is very important because they were the key founders of the business, but you also need to provide, you're going to have to give up equity in the future too to that next tier of management to take you to the next level. And so I've seen a lot of companies get into trouble early on by not really thinking about how they want that company structured on a long-term basis.
Paul, your perspective, from my point of view, is an exceedingly important one, and because you represent life after startup, or death after startup, for that matter. You know what it's like. You see all the time, and I'm just curious. If I were the startup community in that region, I'd just be banging on your door for advice all the time. Do you find that to be the case?
Not too often, only because we don't. Although I very much enjoy this. Again, I don't want to use startup, but this sort of next stage of growth financing. I like this segment, although again, it's not what we sort of advertise ourselves as doing. And so, for the most part, I don't. Certainly, I get some phone calls and meetings on, hey, I'm at this stage in the company. We want to get to this. Could you be of help, even if it's not financially? Just give some advice. And so, on occasion, but I don't necessarily play in those earlier stage circles that much, so I don't see as much of it as maybe as I normally would.
Well, get ready, because if they watch this video, I hope they'll get phone calls. I don't know how you manage your time, but I hope for their sake that they're calling you up.
Well, like I say, I've always been pretty receptive to meeting with those individuals, only because it's one. If those companies are successful, they're going to eventually get to that size and stage that we would find very attractive, from again providing that next round of growth capital or recapitalization or whatever might make sense. And so I'm happy to provide that advice early on, and hopefully that turns into a future opportunity for us down the road. And if nothing else, I think it's just a great thing to do for our community, because the more successful businesses we have that can go from 1 million to 10 million and create 50 jobs along the way, or whatever the number is, it just makes us that much more of a viable, exciting business community to be part of.
Great. Well, Paul, we promised to keep these things short but sweet, so I'm going to wrap up now. Thank you very much, Paul Sweeney. Any enterprising entrepreneur will easily be able to find him with a few Googles. And this is from Scale Up Milwaukee. If you don't follow us, go to scaleupmilwaukee.org. Follow us. We'd love to hear from you. Suggest other hangouts, other people that we can talk to, because all of these experiences, all of these conversations enrich the dialogue, which is about growth, it's about scale, it's about ambition. So, Paul, thank you very much. Look forward to meeting you in person as soon as possible.
Happy to participate. Thanks for all you're doing.
All right.